Let's talk some high-yield bonds and more with Michael DePalma. He's a managing director and portfolio manager of HYLD ETF at McKay Shields. Michael, good to have you on the show. I'm curious right now, we see today the market responding to some soft data here in the U.S., continuing this trend of weaker manufacturing. Just right off the bat, I'm curious your thoughts on what that means for the high-yield market and if there are sort of cracks in the economy, what it means for this space.
I think this number was weaker than expected. It caught a lot of people by surprise. It's interesting. I was just looking at the economic surprise indices that Citi publishes, and they've actually creeped up to positive territory.
Oh, yeah, big time.
Over the last, couple of months has been surprising to the upside.
Yep.
And so here we get this number, which is an important one and one that a lot of people watch. And now, it disappoints to the downside. So anyone who was concerned about, economic weakness sort of has some confirmation. I think it also validates what the Fed has done recently, which is, start to at least lower interest rates. And what you'll see is that what I would expect to see is obviously the market's turned around this morning, rates are rallying. I'd expect to see spreads widening. I think this confirms that we are seeing a slowdown. I think it confirms that we are seeing some impact possibly from, on the trade front. Businesses are concerned and they're going to adjust their operations accordingly. So if you're a credit investor, you have to be a little concerned and you're going to want to take some risk off the table.
Now, tell me, Michael, when it comes to risk for the high yield market, this year, the preference for investors has been some of the more investment grade. It's been obviously treasuries as well, a big rally. What do you make of sort of the lagging nature for high yield, even with the stock market that's been rocking?
Well, I'd say this, if you think about it, you're right. Quality has definitely done better this year, right? So treasuries have done great. Investment grade credit has done great. Within the high yield space, double Bs are up 11.5% year to date, maybe a little more than that, depending on what index you use. Triple Cs are up about half as much, right? So they've done significantly worse than that. So that right there tells you that at least coming into this year, the market has had a preference for better quality, even within the high yield space. They've had a preference for better quality. They've had a preference for better liquidity. So I think the market has been sending you a signal for some time now that they're concerned. The economic cycle is a little long in the tooth, and we need to start positioning. We're yield hungry, but we need to position into more quality assets. I didn't hear anything today. I don't see anything in the data that would suggest that trend would change. You could take the view that the disparity is so great right now that investors may start to look at, down in quality to triple Cs, but, that would be surprising given the data we saw today and given what I think is the prevailing view out there that we're at least at if not the late stages, pretty close to being at a point where we're going to see some kind of a slowdown, and that's when defaults start to pick up. We've already started to see it this year, right? We're a little bit ahead of last year. I mean, defaults aren't at a level now where I would say they're catastrophic. I think we're running at a default rate of around 2.5%. Some of the agencies have forecasted that to go up to 3% or so, but half of the defaults this year are in the energy space, and that has had problems for some time on its own. And so I think for selective investors, there's still things to buy in this market, but taking less risk seems to be where the market has been for a while, and I'm not seeing anything that would suggest that would change.
So, Michael, this is what I think is interesting is for the equity market, a lot of times, even if there is this economic weakness, we say, oh, well, the Fed is going to be here. They're going to take care of things, and the TINA trade lives on. For the bond market side of it, the corporate bond market, which is interesting, is, all right, even if there's not a big blowout in corporate spreads, if cracks do start to form, then there really is more of a fundamental question. But your point here is that even with some of the softness, we haven't really seen that big separation of wheat from chaff yet in the bond market.
Yeah, that's right. I mean, there's everyone's been talking about the yield curve being flat and how that's preceded, periods of recession and so on in the past. We're starting to see it in some of the data. The stock market clearly doesn't reflect that. credit spreads are below 400. I mean, the average spread on a high yield bond now is somewhere around 390. Maybe it's a little bit wider this morning, but we haven't really seen, historically, depending on what index you use, you're talking 4.5% to 5% in historical spreads. So we haven't started to see that widening. We were there earlier in the year. We're a lot tighter than we were on January 1st of this year. But credit spreads haven't yet started to reflect, what I would call real fear in the credit markets. And it's frankly, it's a little bit surprising. One could interpret the fact that the Fed, felt the need to stimulate the economy as a signal that they're obviously concerned about the sustainability of the current expansion. But we're not seeing it in spreads. We're not seeing it in credit metrics either. What we are seeing, though, is the bottom end of the credit spectrum, the low triple Cs, sort of the names in some of the more distressed spaces like energy, like possibly retail and maybe pharmaceuticals. Companies, any company with a little hair on it, any company that, shows any kind of weakness or any inability to possibly refinance or anything like that, you're going to see a massive, those companies are being punished pretty materially. But we also can't forget the fact that, the U.S. is still in an expansion. Maybe it's as low, maybe growth at 2% doesn't sound exciting to anyone, but when you compare it to the rest of the world, it's pretty good. And we also shouldn't forget we have the highest interest rates in the world. $15 trillion of debt have negative yields. And so foreign buying, there's a lot of support for the market, despite the fact that maybe some of the economic backdrop is starting to look a little bit weaker.
Michael, and when you look at your macro take and think about what goes in the fund, HYLD, outline for me how you express that in the holdings. Is it just avoiding those that you think, is it accepting those with a little hair on them and then avoiding the ones that have potential real sort of structural risk? I'm looking at the performance to HYG this year, and it is lagging HYG. Tell me what's going on.
Right. So, if you and I were having this discussion last September, in fact, I think we actually did have this discussion last September, we became concerned back then. And so we started to take risk off the table back in September of last year. So our portfolio is more conservatively positioned. And, that looked pretty good last year, second half of the year. We were one of the few funds that were up last year, but it hasn't helped this year, obviously. And,
right.
You had this outfaced by the Fed, spreads have narrowed, yields have come down, and we haven't participated in that rally, at least not to the same degree that some of our peers have. Having said that, the way we're positioned is still conservative. I expressed some concerns. I haven't seen anything to change that. And so we are conservatively positioned. 50% of my portfolio matures in the next 3 years. So that right away tells you that we're expecting that at least sometime over the foreseeable future for spreads to be wider than they are today, and that should present some opportunities to bottom fish for us.
I see.
I'll also say this much. One of the things we know about bonds that you can't say the same thing with respect to equities, at least, is that the yield that you get is a pretty significant portion of what you're going to earn in terms of total return over a sort of medium to longer term horizon. It may not be indicative over a quarter or even a 12-month period, because you can have big movements in spreads and yields. But over the next 5 years or so, it's going to be a pretty good indicator of what you're going to earn on your bond portfolio. And I would say, we've been able to maintain a pretty decent yield in the portfolio. And for patient investors, we think a more conservative strategy is going to pay off over the next couple of years.
Yeah. Michael, all right. So the takeaway here then is, if you're looking for continued soft patches in the economy and a little bit more, dispersion within performance, that's where you think the fund is going to shine, is in an environment where there's not just a constant bid under risk, basically.
I would concur.
All right. Really good conversation, Michael DePalma. Really informative and helpful here. Appreciate it, Michael. Good stuff. Mr. DePalma is Managing Director and Portfolio Manager, HYLD at McKay Shields. Thanks again.